Silver goes to 500 and then pulls back to 300. Eric Sprott pointed this out in an interview he did some months ago, a couple months even, to see something like, a couple $10 days in silver or $20 days. So these things are compression effects, and they're wrong. They're trying to keep reality from happening. Think, oh my gosh, I can't get in that. That's
right.
I missed it. It's going to crash, et cetera, et cetera. Gold's bear market low was $1,050 in 2015. 8 times that says I could go to $8,500 gold just to match the dimensions of the prior 2 bull markets. It shows the monthly closes of gold plotted as a percent of the price of the S&P. And each month you plot that reading. And when you do, you'll see that there's a trend line, gradual trend line going all the way back to 2014, saying, hey, we could see $9,200 gold. JP Morgan, I think, just came out with that. Based on certain mathematical relations to monetary degradation. The miners used to be worth 25% of an ounce of gold, then they went to 4%. Okay, now what are they going to do? Go to zero? Okay,
Right.
Screw your head on. Okay, silver does what copper did in 2005-6, or what lead did in 2007. Or what gold has done repeatedly at each of its bull market peaks. It goes way beyond the old peak. We project and have projected for months now that when this thing unleashes to a new reality, we call it silver, it's probably going to be, $300 to $500. And only then would, I think Eric Sprott pointed this out in an interview he did some months ago, that if you factored in just the decay in the money unit, and there was the increase in the quantity of the money unit, M2, and factored that back to 1980 or 2011, silver would well be in the hundreds just to get even to those equivalent price levels and reflect the decay in the real buying power of the dollar. And the fact that there might be entities that try to restrain this process, and obviously it hasn't been working. We're not still in the 50s again, okay? They only accelerate it, and they create these boom effects. So it wouldn't shock me somewhere down the road here in the next couple months even to see something like, a couple $10 days in silver or $20 days. So on the upside, bam, 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 where it's just gas, okay, while it seeks its new reality.
The historic parallels between silver and earlier commodity surges suggest hidden upside that few are pricing in. As Michael Oliver points out here, factoring in M2 growth back to 1980 or 2011 would place silver in the hundreds, exposing the decay of dollar purchasing power. Despite market interventions, these restraining forces often amplify volatility, creating sudden $10 to $20 jumps in days. The real risk isn't collapse, but missed opportunity for those unprepared. Investors should watch liquidity and inventory signals closely while silver seeks its new equilibrium. Next, Michael Oliver discusses the explosive potential for silver to reach unprecedented levels.
Michael, we've known each other now for a couple of years. And I remember when we were talking last year, and so, gold had already taken off and silver's starting to play catch up. And it was about then you started talking about, not just going through 50, but, going through 100 and 200 and beyond these targets that you're talking about. And I've been preaching against this. I call it the fractional reserve and digital derivative pricing scheme, right? Where you're not really trading physical metal. You're swapping these derivatives back and forth. And I would sit there and look and go, I can see where he's coming from, but how do we get there without blowing up this pricing scheme, without making it obsolete because the metal's not there backing the derivatives? And then you get things like Wednesday the 25th, and I start to think, well, heck, maybe that's how we're going to get there. Maybe that's how it combines all of this together into your price targets. What do you think of that?
Yeah, these things are compression effects, and they're wrong. In other words, they're trying to keep reality from happening. And ultimately, once the market unleashes itself, as it has, even on a net price basis, it said, I'm not going to live in that old range again. Okay.
The chase for silver beyond $50 exposes systemic fragility in derivative markets. As Michael Oliver points out here, the fractional reserve and digital derivative schemes create a disconnect between physical metal and paper pricing, raising questions about market stability. Breakouts like those on the 25th may reflect the mechanics of forced price discovery rather than organic demand. Investors need to consider whether current gains are sustainable or a product of structural compression. Next, Michael Oliver shows how these market distortions converge into real pricing breakthroughs.
Well, our momentum work said that before that even occurred in price. Momentum said, yeah, you're accelerating.
Right.
In fact, June of last year, silver was coming back up to 35 again. It had already been there a couple times in late 24 and early 25, just above 35. And it dropped hard into April, if you recall, last year. It came roaring back up. And when it was about 34 plus, we said, okay, this time it's different. You're going to accelerate. And sure enough, we went from 35, bam, up to over 50. And then something else happened. And it's a metric we're watching that most people aren't, but we see it as a dynamite metric. And I've sent you some charts that make this point. You know, a lot of people like to look at a price chart, and obviously, if you just look back a year or two or three, and what's happened then, you see this verticality, and you think, "Oh my gosh, I can't get in that. That's
Right.
I missed it. You know, it's going to crash, et cetera, without looking at the context of the longer term reality that it has existed for more than a half a century. Okay, but momentum said, no, it's over. We're coming out of here. Okay, and then price joined. Usually, it's lagged to its own momentum. Okay, fine, but. And so that's our main analysis, is the momentum analysis of the price action.
Momentum indicators predicted silver's acceleration before the price even confirmed it, a nuance lost in conventional charts. As Michael Oliver points out here, June's move to 35 and the subsequent surge past 50 illustrates that vertical price jumps often follow momentum, not precede it. Most investors fixate on prior highs, missing half-century trends that dictate real breakout potential. Understanding these metrics offers clarity on timing and risk for silver positions. Next, Michael Oliver talks about the momentum framework that drives price surges before traditional charts react.
And when we plot it, we get different visual view of the trend structures that you might see on a price chart, like the ceiling, going back 50 years on price, at $50, $50, okay. Well, on momentum, you have similar structures, but they broke out earlier, okay. We're plotting price in relation to a moving average, and we're oscillating it. So it's not just like overlaying a moving average on a price chart. Everybody does that. But where is it in relation to that average? And you create an oscillator, and it gives you a different visual picture sometimes. And usually it will lead price. Okay, forget that. We stepped away from that a bit, and we also looked at relative performance of this versus that. For example, some big things happened on relative performance in the last 3 or 4 months. For example, the issue is for an investor, what's a better place to be? It's always the question. And it's always, well, within the S&P, where's the best place to be? But how about thinking beyond that? Maybe gold is a better place to be than the S&P, or gold and related things. Okay. And if you go back after that 2011 peak in gold collapsed in price down to from $1,900 down to $1,050, and its relative performance to the S&P, and this is the first chart that is being put up.
Standard price charts hide early signals that momentum and relative performance reveal. As Michael Oliver points out here, oscillators versus moving averages often lead price and uncover breakouts missed by conventional metrics. Comparing gold to the S&P over decades highlights undervalued relative strength that most retail investors overlook. Understanding these relative charts can inform better allocation and risk management in precious metals versus equities. Next, Michael Oliver discusses how long-term relative performance frames actionable opportunities for investors.
It shows the monthly closes of gold plotted as a percent of the price of the S&P, and each month you plot that reading, okay? And when you do, you'll see that there's a trend line, gradual trend line going all the way back to 2014, so like 11, 12 years, where you've bumped this line, bumped it. It's a super clear structure. Not on a price chart, but on a relative performance chart. Gold broke through that in November, meaning gold performance broke through this resistance level it had with the S&P, where it had been confined, but basically going sideways for 14 years or so, a dozen or so years. And finally, it punched through this line in November. Well, where was gold in November? $4,200.
Yeah.
Okay. November. Okay, let's start the clock in December because the breakout was the close of November. December, January, now February. 3 months later, we're $1,000 higher in gold net price. And the S&P is unchanged from where it was 3 months ago. Okay, so when these spreads break out, it often does not just signal, oh, one's going to do better than the other. But if the dynamics of that breakout are so clear as this chart is, and it's fresh, you just broke through a dozen-year base that anybody with a crayon could plot the line.
Breaking through a 12-year relative performance line signals more than a temporary move. It indicates structural leadership. As Michael Oliver points out here, gold's rise from $4,200 over 3 months, while the S&P remained flat, highlights asymmetric upside for precious metals. Most market commentary misses that these relative charts forecast momentum, not just price. Investors should interpret this breakout as a durable trend rather than a fleeting spike, especially for portfolio weighting. Next, Michael Oliver talks about how this relative strength defines gold's outperforming trajectory versus equities.
You just broke out a few months ago. This is not ending. This is something that's just beginning. And the initial price response to that spread breakout was a $1,000 gain in gold, and S&P sitting there kissing itself. Okay? Wow. In other words, the spread breakout yielded a massive price surge. At the same time that happened, there's another spread chart. Well, I want to get to another one first. This is one that hasn't broken out yet. This is the really important one right now as far as I'm concerned about February, March. Okay. XAU index goes back into the 1980s. It's the Gold Silver Miners Index, Philadelphia. Gold Silver Miners Index.
Gold Bug Index, or whatever they call it.
XAU. Okay.
Yeah.
And if you plot it in relation to an ounce of gold, we divide the price of XAU in an ounce of gold, go back to the 1980s, and you'll see that on the left side of that chart, it oscillated in a range for decades with lows about 17.5% to 18%, meaning XAU would drop down to that relative value to gold, and highs above 30%. So if you look at that range and sort of divide it in half, you'd say, well, it lived on either side of about 25% of an ounce of gold. XAU expresses an ounce of gold. It collapsed in that bear market in 2015.
Miners' relative performance charts reveal early breakout signals most investors overlook. As Michael Oliver points out here, the XU index oscillated between 17 to 30% of gold for decades, only collapsing to 4% during the 2015 bear market, highlighting extreme undervaluation. Recent breakout patterns indicate a potential multi-decade shift, suggesting that gains in gold could propagate dramatically through mining equities. For long-term investors, this underscores opportunity in miner exposure while the broader market remains stagnant. Next, Michael Oliver discusses how this unbroken pattern sets up February-March as a pivotal period for gold and miners.
Got all the way down to 4%.
Oh, shit.
In other words, the miners used to be worth 25% of an ounce of gold. Then they went to 4%. Okay, now what are they going to do? Go to zero? Okay, right. Screw your head on. Okay. Since then, that spread has lived in a range, perfect little box, for a dozen years plus, with highs at the same level. Every time it goes up to like over 8%, it gets knocked back down a bit. It doesn't go back to that 4% level. No, it didn't. It left that alone, but still lived in a range. You're now with 1 day left in the month. If you close tomorrow where the spread is right now, you're going to break out of that massive spread range. Similar to that line we broke out of, where gold broke out over the S&P, okay, November, and shot up $1,000, even in the pullback, it's up $1,000 in price. Not just beating the S&P, but also a surge in gold. Well, here the gold and silver miners relative to gold are saying, I'm back. I'm reborn.
Yeah.
And I'm still at 8.7% of the price of gold compared to lows that were 17, 18%. In other words, when you look at that chart, if you broke out of that base and ran up to the bottom end of the multi-decade prior range of reality,
Right.
you'd more than double the current relative value of the gold miners to gold. So wake up. Something's just beginning. You don't break
So
that
this,
spread out and top the market. Okay.
Mining equities are flashing a structural rebound that's easy to miss in headline price movements. As Michael Oliver points out here, gold miners' value relative to gold is climbing from 8.7% toward the multi-decade baseline, reflecting a potential doubling without risking a market top. Historical lows and range behavior indicate that breakout momentum could persist, unlike transient market spikes. Investors need to interpret this as a recovery phase in minor leverage rather than a speculative frenzy. Next, Michael Oliver shows how relative spreads define where gold miners may run next.
Price. Good grief, right now we're 1.68 or something, okay? You could double, triple the price of silver relative to gold just to get to the old highs on the spread. So all these factors are saying sudden, now, and new reality.
Yeah.
And then when we do the silver miners, that's a chart at the bottom of that page, you'll see silver miners are broken out versus gold miners, echoing the breakout of silver versus gold. Conclusion, be in the monetary metals, be more focused in silver and the silver miners.
I'm doing that math in my head.
Okay.
I mean, the gold chart since the breakout about this time 2 years ago has followed us. I mean, anybody can pull up a weekly chart, just a price chart, and see it. It goes up 20% and goes sideways, goes up 20% and goes sideways. Another 20% takes it to 6,000. 3.1% of 6,000 is 183.
Yeah, well, the gold in its prior bull markets, by the way, it usually doesn't do that layered process all the way. You'll do that
interesting.
4 steps up, 2 steps back process during the bull trend. But then suddenly in the latter part of the bull trends that gets you to the new reality, you go more vertical.
Silver and silver miners are mirroring gold's breakout trajectory, hinting at unseen leverage across metals. As Michael Oliver points out here, silver miners' ascent aligns with gold's layered 20% up sideways cycles, yet the latter stages move sharply vertical, an acceleration often underplayed by mainstream reporting. Retail investors risk misjudging timing if they expect smooth progression. Understanding these patterns is crucial to avoid chasing or missing real growth phases. Next, Michael Oliver unravels how silver miners echo gold's breakout, signaling a new reality in precious metals exposure.
The behavior changes, which fools people because they're used to the old layered behavior. And they think it's going to, once you've made a high, you're going to stay there for 4, 5, 6 months. In a range, or you're going to pull back. Don't expect that this time. If gold matches its bull market peaks of 1980, 2011, in terms of the ratio dimension of the bull market from bear low to that bull high, bear low to the bull high, those were both eightfold moves. Gold's bear market low was 1,050 in 2015. 8 times that says I could go to $8,500 gold just to match the dimensions of the prior 2 bull markets. And what's really curious is that we've had this analysis for quite a few months now. Not saying we're just going to go to 8,000 plus. That's just the norm. I mean, we'll probably go well beyond. Suddenly now some major brokerage firms, big name firms, have come out with similar numbers, saying, hey, we could see $9,200 gold. JP Morgan, I think, just came out with that, based on certain mathematical relations to monetary degradation and so forth and so on. But a lot of big firms are now coming out with our numbers for various reasons, which is interesting.
Investors are conditioned to expect layered, gradual moves, but gold's next phase may be exponential. As Michael Oliver points out here, historical eightfold bull moves from 1980 and 2011 suggest gold could reach $8,500 from 2015 lows, far beyond conventional forecasts. Even major firms like JP Morgan now echo these projections, reflecting broader recognition of monetary degradation's impact. For portfolio allocation, this calls for revisiting exposure to precious metals versus equities. Next, Michael Oliver discusses how historical bull ratios set the framework for extreme upside in gold.
But I think that this bull move is now in the acceleration phase, where we're going to get most of what you're going to see, most of the rewards you're going to get if you're long will occur between now and summer.
Michael, what would have to happen? I mean, you've been on this, like you said, since June, reiterating things last year. I remember you talking about, it's going to get to 80 by the end of the year. And I was like, God, I love you, Michael, but geez. And then here we were. And now, so what, this is all very compelling, and you see the numbers for the metal and you translate that to the miners with their leverage versus their margins. And you think, well, I can certainly see why then the gold shares and the silver shares should be breaking out as well as a ratio. My last question is, what would cause all of this to reverse in your mind, to go, you know what, we're going to have to rethink this?
We don't see the technical dynamics for a top. And when we see a top, and by the way, we do call tops in gold. 2011, 3 months off the high, we said, that's it, it's over, bear market coming.
The acceleration phase rewards patience but warns of structural risk if ignored. As Michael Oliver points out here, minor leverage amplifies gold and silver share gains. Yet no technical signals indicate an imminent top, unlike in 2011 when a 2 to 3 month lag flagged the bear market onset. Investors need to align position sizing with historical behavior rather than media hype. Understanding this can protect long-term portfolios while capturing upside. Next, Michael Oliver talks about conditions that could reverse the current bull trajectory.
Well, the bear market really didn't start to unfold till 2013.
Right.
We labored off that $1,920 high in late 2011, dropped down, and in December of 2011, we said, we're bearish. And it floundered for a year and then finally crashed.
Okay. Yep.
But there were reasons for that, not just the price chart. There was a momentum structure. When you plotted the annual momentum of gold versus its 36-month average, for example, it oscillated. You had an 8-point uptrend line that you broke. You couldn't see it on a price chart, but on momentum said, God, you just blew the bridge over the River Kwai, man. Okay. And that we said, that's it. You're done. And it took a while to collapse. It finally did. We don't have any such structure set for gold and silver right now. In other words, before you really top and have a major pullback, like silver goes to 500 and then pulls back to 300, let's say, probably you're going to have momentum structures develop, and they're not there now. You haven't even developed the structures. Up under the market, where if you sneeze off the high, you're going to break the structure. Right now, any structures we have that you could break and look at a momentum chart and say, oh, it broke its trend, they're not even near the market.
Got it.
So therefore, we do not think there is any major downturn potential here.
Not yet, huh?
Yeah.
Unlike 2011 to 2013, current gold and silver markets lack momentum breakdowns that historically preceded major pullbacks. As Michael Oliver points out here, the absence of under-market momentum structures implies little immediate risk, even if prices spike dramatically. Investors conditioned on prior layered collapses may misread early signals and overreact. Monitoring for emerging momentum lines is key to distinguishing a true top from ongoing upward trends.